James, what a week. It's been quite a ride, huh?
It's been crazy. I think that people are still trying to figure out, what's going on. I think investors are shell-shocked, and people are trying to figure out how to price energy risk in this environment.
So how do you even go to analyzing the fundamental picture of, say, the shale patch, given the fact that we've seen a wild move in oil and you've got a price war between Saudi Arabia and Russia?
You know, we've been here before. There's a precedent, 2015, 16. And so, companies have a playbook that they can open up, and they can adopt a lot of the same types of policies. We just saw Oxy cut its dividend. Companies are going to be cutting back capital spending across the board, trying to hunker down and retrench as much as possible in this environment.
There's a question of near-term financing, and there were a couple stories this week about energy firms, shale companies, that are going to the banks and saying, can you spare a dime? Can you lend us some money to get us through this? How willing do you think, or are you hearing the banks are, to actually extend new loans to some of these shale companies?
I do not think there is a lot of appetite amongst the banks to extend additional credit. Banks that already have credit outstanding to high-yield energy companies especially are probably looking to reduce risk to the extent that they can. Now, they have their commitment levels outstanding to these companies, and they're not going to pull the rug out from underneath these companies, but there are borrowing-based redetermination seasons. The spring borrowing-based redetermination season is coming, and we expect to see some cuts from the banks.
If the banks do cut, and that season is coming up, what kind of insolvency rate are we looking at here?
Well, the banks are not likely to be the trigger to push a company into a deficiency or a workout or a bankruptcy. The banks don't want a whole portfolio of workout companies on their balance sheet. I think, banks are going to be prudent about trying to reduce risk, but they're going to do so in a way which leaves companies an ability to try to resolve the situation themselves. I think that more importantly, the near-term trigger for default is going to be refinancing.
Okay, we're looking at $120 billion, $20 billion less than it was yesterday, of high-yield energy debt in the United States. Can you give us a sense of what kind of defaults we're talking about here? How much of this debt could end up in default?
It's a question of time. I think in the near term, companies have hedges in place, companies have liquidity, companies have maturity runways for the most part. It's really a question of how long this low price situation lasts for. It's a question of how long the Saudis are willing to take the pain to produce 12.3 million barrels a day. At
$30 a barrel traded on the NYMEX, what kind of bankruptcy rate are we going to see here?
I think over the near term, in 2020, really just a handful of companies, maybe 3 or 4 companies in the high yield sector, are at significant risk. I think if this lasts longer than, say, 3 to 6 months, then that universe grows significantly. Could it be, 30, 40%? Possibly.
Within the next year?
Within the next year, possibly.
If the prices stay where they are?
If the prices stay where they are.
And if not, perhaps a buying opportunity?
We hope so.